Most people think the danger in real estate is overpaying for the property. They think the mistake is buying in the wrong neighborhood, taking the wrong mortgage, missing the timing, trusting the wrong contractor, or getting caught at the top of the cycle. Those things matter. But there is a quieter mistake that ruins more outcomes than people realize, and it almost never feels like a mistake when it begins. It feels like a win. You buy a property, your accountant shows you deductions, your taxable income falls, you hear words like depreciation, cost segregation, write-off, paper loss, and tax efficiency. Everyone around you starts acting as if real estate has some magical ability to create wealth and erase taxes at the same time. That is where the trapdoor opens. I have spent my life watching how people talk about assets, and I can tell you this, the most dangerous financial structures are the ones that feel generous on the front end and punitive on the back end. They hand you relief early so that you stop asking what the bill will look like later. Real estate can be wonderful. It can produce cash flow. It can compound. It can protect purchasing power. It can give you leverage over time instead of forcing you to sell your hours forever. But if you do not understand the tax architecture under the property, you can spend years congratulating yourself for saving money when all you really did was push a tax liability into the future, enlarge it, and make it harder to manage when it finally arrives. That is the game almost nobody explains clearly. People copy the surface behavior of wealthy real estate investors and miss the underlying operating system. They see the acquisition, they see the deductions, they see the refinance, they see the appreciation, they see the confidence. What they do not see is the discipline around one question: what exactly triggers the tax? If you do not know the answer to that question with precision, you are not running a strategy. You are walking across a floor without knowing where the trapdoors are cut. That is the mother line I want you to hold on to. Real estate is full of trapdoors. The amateur walks around admiring the flooring. The professional memorizes where the floor gives way. Once you understand that, a great deal of fake sophistication falls apart very quickly. I have seen people talk about a property as if it were a tax shelter when what they really owned was a future tax event with good marketing. I have seen people brag about the size of the write-offs they captured in year one without the slightest understanding of what those deductions were going to do to the back-end tax character when they sold. I have seen people accelerate depreciation, celebrate the reduction in current income, and then act shocked when the government came back to reconcile the entire history of the asset in one ugly moment. That shock is not bad luck. That shock is structure, and structure is where intelligent investors live. The first trapdoor is what I call the paper win illusion. This is where someone mistakes a temporary tax reduction for a permanent tax saving. It happens because the early experience feels so satisfying. You buy a property, you take depreciation, maybe you improve the property and increase basis in the right places. Maybe you run a cost segregation study and front-load deductions even more aggressively. The return looks better, the tax bill looks lighter, you feel clever, but a one-year tax result is not the same thing as a completed investment result. That difference is where grown-up investing begins. A deduction is not the end of a sentence. It is usually a comma. And in real estate, that comma often leads to a very long second half that people do not bother reading until they are already standing in it. The tax code does not merely care that you took deductions. It also cares what happens when the asset leaves your hands, changes character, gets distributed the wrong way, or gets sold in a way that converts years of quiet deferral into one loud moment of recognition. That moment is the second trapdoor. I call it the trigger line. Every asset has a line you do not want to cross carelessly in real estate. That line is often the taxable event. A sale can trigger it. A distribution out of the wrong entity can trigger it. A poorly structured disposition can trigger it. The part that amazes me is not that the tax exists. The part that amazes me is how many people build an entire financial identity around real estate without understanding that the moment of exit is often where the illusion ends and the accounting becomes real. You do not get judged by the deductions you enjoyed in isolation. You get judged by the full life cycle of the asset. That is how intelligent capital thinks, not in snapshots in full arcs. If I buy a business, I do not just ask what the first year looks like. I ask what the economics look like when the easy optimism is gone and the entire chain of consequences has had time to surface. You should think about property the same way. What did I buy? How was it depreciated? What did I accelerate? What tax character did I change? What happens if I sell? What happens if I distribute? What happens if I need liquidity before I plan for it? What happens if the structure I used for efficiency turns out to be the same structure that magnifies the bill when I exit? Those are adult questions. Most people prefer childlike answers. They want real estate to be a machine that prints deductions and appreciation while somehow never presenting a bill. That is fantasy. The government is patient. The IRS does not need to interrupt your party in year one. It can wait. It can let you enjoy the deductions. It can let you tell yourself a story. And then, when the triggering event arrives, it can reconcile years of tax history in a way that feels brutal only because you refuse to study it in advance. That is the third trapdoor. I call it the reconciliation wall. This is where the asset stops being a nice narrative and becomes arithmetic. Depreciation recapture is one piece of that wall. Capital gain is another. And if you altered the character of the deductions through aggressive front-end structuring, the wall can become steeper than you expected. This is where many investors finally discover that real estate tax strategy was never about whether they could get deductions. It was about what kind of tax bill those deductions were quietly preparing. Depreciation is attractive because it lowers taxable income while you hold the property. But depreciation is not an act of mercy. It is an accounting event with memory. You reduce basis as you claim it. Then when the triggering event comes, the tax code starts to ask a very reasonable question: how much of what you saved earlier needs to be accounted for? Now that is where people who thought they were only dealing with appreciation realize they are actually dealing with layers. One layer is the gain that comes from the property rising above purchase price and adjusted basis. Another layer is the recapture of depreciation benefits already taken. Those are not the same thing. They do not always get taxed the same way. And the structure you chose along the way can change the character of the pain that matters enormously. The fourth trapdoor is what I call the character switch. This is where the front-end strategy makes the back-end bill more expensive than the investor imagined. Cost segregation is a good example of why intelligence matters more than slogans. Used properly, it can be useful. Used blindly, it can create a smile now and a grimace later. If you take part of what would otherwise live in a longer life real property bucket and reclassify it into shorter life property so you can accelerate depreciation, you have not performed magic. You have changed timing and, in some cases, changed tax character, and tax character's destiny when the bill comes due. Let me say that another way: people think they created a bigger benefit because the write-off got larger sooner, but sometimes what they really created was a larger future vulnerability, because what would have come back at one type of recapture treatment may now return under a harsher ordinary income style result. That is not trivia. That is the difference between a strategy and a trap. A lot of financial pain comes from misunderstanding timing. Even more comes from misunderstanding character. If you take $240,000 of depreciation and one version of the structure points that amount toward one kind of recapture outcome, while another version points it toward a materially higher one, you did not merely change the calendar. You changed the shape of the future tax bill. That is why I do not admire people for being aggressive. I admire them for being precise. Aggression without precision is just delayed self-harm. Precision is what wealthy investors are actually buying when they hire good planners and refuse to treat tax law like cocktail party entertainment. The fifth trapdoor is the short horizon trap. This one gets people because our culture rewards visible front-end wins. Somebody shows a tax return with large deductions and the audience applauds. Nobody asks whether those deductions were captured in a structure designed for permanence, deferral, rollover, or eventual basis reset. Nobody asks what the exit path looks like. Nobody asks whether the investor has actually solved the problem or merely postponed it. And postponement is not the same as victory. Sometimes deferral is excellent. Sometimes deferral is the whole point. But only if you understand what the deferral is buying you and what path keeps the trapdoor shut. This is where serious real estate investors separate themselves from real estate performers. The performer asks, "How much can I write off this year?" The serious investor asks, "How do I build a structure where the taxable event either gets deferred properly, transformed intelligently, or never triggered voluntarily at all?" That is a completely different level of thinking. It is not about tax tricks. It is about tax choreography. The wealthy investor is not dancing around the rules. He is learning the rhythm of them. He knows which foot can move and which one will send him through the floor. That brings me to the part most people should have learned first and usually learn last. The real estate winners are not simply good at buying. They are good at controlling the trigger. That is the entire game. You win not merely because the asset appreciates. You win because you decide when gain is recognized, how recapture is managed, whether the structure carries forward, whether the basis gets reset, and whether liquidity can be found without voluntarily stepping on the trigger line. That is what I call control of the switch. And if you do not control the switch, you do not control the outcome. You are just riding along hoping the house goes up fast enough to pay for your lack of planning. Hope is not an investment strategy. It is what people substitute for one when the jargon gets ahead of the understanding. Now, once you truly understand the trapdoors, the strategy becomes much clearer. The first intelligent move is not to ask how to erase tax. It is to ask how to avoid unnecessary triggering events. That mindset alone will save people a fortune, because once the event is triggered, the conversation changes before the event. You have options after the event. You have consequences. That is a brutal distinction. And I have watched people discover it far too late. They sell first and ask for help afterward. They take possession of cash and then want the tax law to pretend the sequence did not happen. It will not. The rules are not sentimental. They care about what was done, when it was done, and whether the steps were executed properly. This is why a properly executed 1031 exchange has such enduring value for people who understand the architecture. A 1031 exchange is not exciting to the average person because it does not feel like a flashy win. But it is one of the cleanest examples of strategic patience in the tax code. You are not pretending the gain vanished. You are carrying it forward. You are not pretending depreciation. History does not matter. You are deferring recognition by moving into another qualifying property under the right rules. That is a grown-up move. It says, I understand that a triggering event is expensive, and I would rather keep the capital compounding inside the real estate machine than tear the structure open just to congratulate myself for selling. The amateur wants a finish line. The professional wants continuity. That is one of the deepest lessons in wealth building. A lot of fortunes are made not by winning once, but by refusing to force recognition before the compounding cycle has done its real work. Still, even here, the trapdoors do not disappear. They just move. A 1031 is only as good as its execution. People routinely misunderstand the reinvestment requirement. They think rolling over some portion of the net cash is enough. They forget that debt relief matters. They forget that equal or greater value matters. They forget that replacing the debt can require new debt or new cash. They think they completed the exchange because emotionally they intended to. The tax law does not score intention that way. It scores structure, it scores sequence, it scores reporting. And if the exchange is not reported properly, the taxpayer can end up acting as if a strategy happened that, from the IRS perspective, never arrived on the page in the form it needed to. That is not a small clerical matter. In a rules-based system, paperwork is part of reality. People love the story of smart investors. They rarely love the part where smart investors respect forms, timelines, mechanics, and boring precision. But that boring precision is where the money lives. I have said for years that I would rather own a good system than chase a dramatic outcome. The system keeps paying you after the excitement leaves the room. A sloppy investor can get one exciting year. A disciplined investor can get a lifetime of compounding. And in tax-sensitive real estate, that discipline is often the difference between staying on the staircase and falling through the trapdoor. The next level of intelligence is even more powerful. It is understanding that deferral is valuable, but permanent avoidance of the triggering event can be more powerful still. This is where basis reset becomes one of the quiet marvels of long-horizon planning. If a property is held until death, the basis can step up to fair market value. Now pause there. That means the deferred gain that was sitting inside the property can disappear for income tax purposes. The recapture issue that would have surfaced in a sale does not strike the same way because the basis has been reset. The asset has effectively crossed the finish line without forcing the owner to walk across the trigger line during life. That is not a loophole in the childish sense. People use that word. It is a structural feature of the code. And sophisticated investors think about it constantly, not because they are morbid, because they are strategic. They understand time. They understand compounding. They understand that there are only a handful of truly giant levers in wealth preservation. And one of them is keeping appreciated assets inside a structure where gain is deferred for so long that the basis question gets solved in an entirely different way. That is why some people are not selling. From the outside, it looks irrational. Why not cash in? Why not lock the profit? Why not clean the slate? Because the experienced investor knows that cashing in can be the expensive move. He knows that a refinance may provide liquidity without sale. He knows that cash flow can fund lifestyle. He knows that if the property is strong, the tenant base is sound, the leverage is manageable, and the tax architecture favors patience. Then selling for the sake of emotional closure can be one of the dumbest decisions in the room. This is where amateurs and professionals stop even resembling each other. The amateur thinks ownership means control over the asset. The professional knows ownership also means control over timing. And timing is often worth more than the headline gain. Then there is one more piece, and this is where the machine really reveals itself. Even while deferring gain on old properties, serious investors often continue buying new ones. That matters because recycled basis is not the same as fresh basis. When you carry a property through 1031 exchanges, you are carrying deferred gain and carryover basis realities with it. That can be excellent for continuity, but it does not magically create a brand new universe of untouched depreciation every time. So sophisticated investors do something very intelligent. They keep feeding the machine with new capital, new acquisitions, new basis, and new depreciation opportunities. I call this the fresh basis engine. This is one of the clearest ways to tell whether someone really understands real estate or merely talks about it. He does not just recycle yesterday's tax posture. He keeps creating new basis with new purchases. That means new deductions can coexist with deferred old gain. It means the machine keeps throwing off current year advantages while the old trapdoors remain carefully sealed. That is a very different posture from the person who bought one property, got excited about the write-off, and assumed he had cracked the code. One property is not a machine. One lucky year is not a system. The fresh basis engine is a system. It says, I understand that wealth is not merely about extracting benefits. It is about renewing them. You do not want a strategy that worked once. You want an operating system you can live inside. That is how the wealthy tend to think. They do not ask, how do I win this year? They ask, how do I arrange my affairs so that each year supports the next one? Each asset talks intelligently to the others, and the trigger lines remain under my control. You can see now why I say the real game in real estate is not about deductions. It is about control over character, control over timing, control over reporting, control over sale, control over refinancing, control over rollover, control over whether the gain is merely deferred, efficiently transferred, or wiped away through basis reset after a lifetime of patience. That is the difference between looking rich and being structurally hard to damage. A lot of people are looking for tactics. What they need is a doctrine. The doctrine is simple. Do not confuse temporary relief with permanent victory. Do not trigger what you do not have to trigger. Do not accelerate deductions without understanding the back-end consequences. Do not treat cost segregation like free money. Do not sell just because the number got bigger. Do not assume taking cash is neutral. Do not assume the government forgets. Do not assume paper savings are the same thing as lifetime savings. And above all, do not walk around admiring the floor without learning where the trapdoors are. When I look at the best capital allocators, I do not see people obsessed with complexity for its own sake. I see people obsessed with avoiding self-inflicted errors. That is what good tax planning is. It is not showmanship, it is error prevention. It is not a hunt for exotic cleverness. It is a refusal to trigger dumb consequences. And that is a much bigger deal than most people realize. A great many fortunes are not built by brilliant moves. They are built by avoiding unforced losses. Taxes are often one of the largest unforced losses in an investor's life because they are so frequently triggered by impatience, ego, bad sequencing, and theatrical confidence. The investor who knows how to hold, exchange, refinance, and continue building fresh basis is doing something deeper than chasing deductions. He is building an asset life that stays coherent across decades. That is a wonderful thing when done properly. But it only works if you stop pretending the tax code is a collection of cute tricks. It is not. It is a system of gates. Every gate has a cost. Every gate has a sequence. Every gate rewards the person who arrives prepared. If you are buying a house or an investment property in the next few years, I want you to think less about whether someone online called it tax efficient and more about what the life cycle of the asset really looks like. What entity will hold it? How will basis change? What deductions are you taking? What character are those deductions creating? What event would force recognition? Would you want to sell, exchange, refinance, or hold? Could the property be carried for the long term? Would the economics support patience? Are you building one isolated transaction or are you building a machine? Those are the questions that separate the adults from the tourists. The tourist wants a selfie with the asset. The adult wants a 30-year map. I am always amazed by how often people will spend hundreds of thousands or millions of dollars on property and then become casual the moment the conversation turns to tax architecture. That is backwards. The architecture determines whether the economics stay yours. A good property inside a careless structure can still produce an ugly result. A good property inside a disciplined structure can become an extraordinary compounding vehicle. That is why serious people study not just the asset, but the rules surrounding the asset. You do not need to become a tax lawyer to understand the big idea. You just need enough honesty to admit that your first impression is usually too shallow. If all you know about real estate is that it offers depreciation and tax benefits, you do not know enough yet. You know the bait, you do not know the mechanism, and the mechanism is where the future is written. I would rather have a person buy one less property and understand the trapdoors than buy one more property in a fog of false confidence. Because false confidence creates urgency. Urgency creates bad exits. Bad exits create triggered gains. Triggered gains create bills. Bills force sales. Forced sales destroy negotiating power. And once negotiating power is gone, wealth starts leaking faster than most people thought possible. That is the chain reaction. That is why the game is not merely buying. It is controlling the exits so that compounding gets the longest possible runway. I have always believed that the first duty of capital is survival. Only after that comes growth. A real estate strategy that hands you big deductions but leaves you exposed to confused exits, painful recapture, or unnecessary sales is not a fully intelligent strategy. It may still work. Many sloppy things work for a while. But working for a while is not the same thing as being worthy of trust. Trust belongs to systems that remain sound when the easy year is over. The highest form of financial intelligence is not knowing how to celebrate a deduction. It is knowing what the deduction is attached to, what future it is inviting, and what price you will pay if you step through the wrong door. That is why the people who truly win in real estate are not the loudest. They are not usually the ones boasting about the latest paper loss. They are the ones quietly managing trigger lines, quietly extending compounding, quietly protecting basis strategy, quietly exchanging when exchange is appropriate, quietly holding when holding is smarter, quietly borrowing when borrowing preserves structure, and quietly buying new assets that create fresh basis while the old machine keeps running. From a distance, it looks like tax magic. Up close, it is tax discipline. And discipline is always more dependable than magic. So before you tell yourself that a property is a tax win, ask a harder question. Where is the trapdoor? What exactly would trigger the bill? What kind of bill would it become? What part of this strategy is permanent? What part is deferred? And what part becomes more dangerous if I rush the ending? If you can answer those questions, you are beginning to think like an owner. If you cannot, then slow down, because real estate can build wealth beautifully, but only for the investor who understands that every deduction comes attached to a structure. Every structure comes attached to a future, and every future belongs to the person who learns where the floor gives way before he starts celebrating the room.